Welcome back to The Explainer. Today we're unpacking a really fascinating story of financial resilience and, quite frankly, a massive, aggressive cleanup. We're looking at Bandhan Bank's performance for the FY26 fiscal year. Now, if you just glance at the raw annual numbers, you might think, wow, rough year. But when you actually break down the data, a totally different, very clear strategy emerges. It's the story of a bank taking a massive, calculated hit right up front to just clear the decks, perfectly setting the stage for a seriously sharp fourth quarter recovery. Let's get right into it. Okay, let's dive into this, because this specific number, it's basically the absolute anchor of our whole story today. 4,131 crore rupees. That is a staggering amount. It's what Bandhan Bank took in provisions and contingencies during FY26. It completely explains the intense pressure the bank's annual performance was under. But, what does taking a hit of that sheer magnitude actually mean for the bank's underlying health? Let's quickly demystify the jargon here, just so we're all on the same page. When a bank realizes that some of the money it lent out might not actually come back, what we call bad loans, or NPAs, they can't just ignore it, right? They literally have to set aside their own profits to cover those potential losses. That's a provision. Think of it as basically an emergency rainy day fund. So by taking this massive 4,131 crore provision, Bandhan Bank was aggressively preparing for bad weather. They chose to take the financial pain immediately, taking a huge bite out of their bottom line just to make absolutely sure the core of the bank stayed completely protected. Section 1. Absorbing the shock, the FY26 reality check. And this brilliantly illustrates the exact cost of that cleanup strategy when we look at the official financials. Because of that massive 4,131 crore allocation, the overall profit after tax for the entire FY26 year came in at a pretty muted 1,224 crore rupees. And because of that, the bank's return on equity for the year sat at just 4.8%. Honestly, if you stopped reading the report right there, you'd probably assume the bank was just in deep trouble. But remember, this wasn't money just lost to the wind. It was money intentionally locked away for safety. Section 2. The pivot. The Q4 resurgence. Okay, so once those massive provisions were securely in place, the true earning power of the bank was basically unleashed. And the contrast here is just phenomenal. Compared to that sluggish annual return on equity of 4.8% we just talked about, the fourth quarter sparked this incredibly sharp bounce back to 8.5%. This is a textbook indicator of a turnaround taking effect. It shows that the underlying business actually generates highly competitive returns when it's not being completely dragged down by the need to build up those massive emergency funds. The actual profit numbers capture this momentum perfectly. Think about this. In Q4 of the previous year, profit was at 318 crore. But Q4 FY26, it saw a massive jump to 534 crore rupees. That is an explosive 68% year-on-year growth. And honestly, even more striking, on a quarter-on-quarter basis, this represents a 159% surge in profit. This kind of rapid stabilization proves that the core operations were highly profitable all along. They just really needed those heavy clouds of provisioning to clear out. Section 3. Strengthening asset quality. So how do we know this incredible profit jump wasn't just, a one-off fluke? Well, the answer lies right in their loan book. A year ago, gross non-performing assets sat at an uncomfortable 4.7%. But through some seriously aggressive disciplined cleanup, they've driven that down to a much healthier 3.3%. Net NPAs, which actually factor in the provisions they've already made, fell from 1.3% to a highly manageable 1.0%. This fundamentally changes the entire risk profile of the bank. It's a steady, hard-won improvement. Now, what's really interesting about this slide is anchoring these claims directly to the official performance highlights, which reveals a massive 144 basis point drop in gross NPAs in a single year. Similarly, there was a 32 basis point drop in net NPAs. So they didn't just grow their loan book, which, by the way, did grow by 13% to 1.54 lakh crore. They drastically improved the actual underlying quality of the loans inside it. And this brings us full circle right back to our very first data point. Remember those incredibly painful 4,131 crore rupees in provisions? Well, here is exactly what that pain bought them. A provision coverage ratio of 84.9%. Let me put that into perspective. This means that for every 100 rupees of bad loans the bank has, they already have nearly 85 rupees set aside in cash just to cover it. It is an incredibly safe, highly conservative position. They have effectively built a financial fortress around their balance sheet, heavily protecting the bank against any future economic shocks. Section 4. Built for the future. Now, a turnaround is really only as good as the structural changes you make to ensure the same problems don't repeat themselves, right? Well, secured advances now constitute nearly 56% of the bank's total loan book. Over the last year, this specific segment grew by a massive 25% year on year. So, by actively pivoting to safer collateral-backed bets, they're ensuring that their lending growth doesn't just bring in a whole new wave of unsecured bad debts. It's a very clear strategic move toward lower risk revenue. And if you want to talk about a safety net, look no further than this metric right here, 18.0%. This is the bank's capital adequacy ratio, or CARR, including profits as of March 31st, FY26. To give you some context, the regulatory requirement, like the absolute minimum the government says they must hold, is only 11.5%. So sitting all the way up at 18.0% gives Bandhan Bank immense security. It means they have this massive buffer of capital, not just to absorb any unforeseen shocks, but to aggressively fund future growth without constantly needing to go out and raise new equity. This whole strategic shift? It wasn't an accident. It was heavily orchestrated from the top down. As the managing director and CEO, Partha Pratim Sengupta, stated, Bandhan Bank's FY 2025-26 performance underscores the strength of our franchise, supported by disciplined execution and diversifying business model. Actually, that phrase, disciplined execution, that's the real key here. It was the sheer discipline to take those heavy provisions up front, clean up the NPA mess, and pivot towards secured lending that successfully guided them out of a really tough period and straight into a highly profitable fourth quarter. So, we finally arrive at the ultimate question. We've seen them take the medicine, absorbing over 4,100 crore in provisions. We've seen the fever break with an explosive 159% quarter-on-quarter profit surge, dramatically falling NPAs, and an ironclad 18% capital adequacy ratio. With a newly cleaned balance sheet, strong retail deposit growth, and a definitive pivot towards safer secured loans, is Bandhan Bank positioned to absolutely dominate the market in the coming year? The data from this turnaround certainly points to a pretty fascinating journey ahead. Thank you so much for joining me on this explainer, and definitely keep your eyes on those numbers.